Hi, I'm Scott Shellady here for Traders Exclusive on the CME Group floors in Chicago. It's my last Friday. I leave again to go back to the UK this next week, and just in time for the Ryder Cup. I know that's something that everybody else will be watching, especially me. But anyway, let's talk about what they've been talking about. I like to talk about what they've been talking about, and a lot of it's been the dollar. A lot of it's been what the stock market's been doing and with what the Fed's been doing. And here's my overall view on everything as of late. We had a Fed meeting this week. They raised interest rates a quarter. Look, as long as I've been doing this job, 31 years, I've said this before, that the only time I remember raising interest rates was to get out in front of an overheating economy or try to stop an economy that's already been overheating, right? And I just don't think we're overheating. We're doing better, right? So that's the really perverse thing that I think that the Feds or Powell has been having to deal with. The good numbers are coming in good and the bad numbers are coming in bad, and that's really good. What I mean by that is this: good numbers, the growth numbers, those types of things, expanding economic numbers, those are coming in good. Look at the GDP, for instance. Durable goods crushed it yesterday. But then when you look at the, say, inflationary numbers, well, they're not coming in inflationary, right? So their bad numbers aren't coming in so bad. That's got some people flummoxed because we're not really seeing that inflation, but it looks like the economy's doing well. Do I raise rates or do I not? I think that they're on this path. I think that they might be a little bit too aggressive right now. We'll have to wait and see if we get another one at the end of the year. A lot of pundits think that's going to be the case. However, that dollar getting stronger has been something that's been very interesting as of late, as well as they always are asking me now as this week about, after the Fed move, why did the 10-year rally so much to see yields drop? I'll give you one simple answer on that one, too. We had so many people short that market getting ready for the rate hike that did finally come. When they all got what they wanted, they looked around to see who was going to get them out of their position, and there was nobody there to sell them the bonds back that they had already shorted. And so to get out of their positions, they had to buy their bonds back, buy their short bonds, and they've cannibalized themselves on the way out, driving up bond prices, driving down the yields, and I think that's why we've seen a short-term drop in yields or a short-term rally in bonds, just because of positioning. That happens all the time. Pundits got it right. We were looking for a rate hike. They got it, and they can't get out. And so a lot of times you'll see markets kind of do that when it's kind of a perverse, a lot of times it happens in the grain room as well, a perverse move. It's only because everybody's got it on that way and there's nobody there that'll let them out of their positions, and the market kind of goes a little bit wobbly on them. That's exactly what I think happened in Treasury. So that's it from me. I'll be back in London again next week, but I'm Scott Shellady for Traders Exclusive. Have a good weekend. I'll see you next week.